How do you calculate current liabilities on a balance sheet? Have you ever wondered how businesses keep track of what they owe in the short term? Understanding current liabilities is a key part of financial statements and balance sheets. Let's break down how to calculate current liabilities step by step. Current liabilities are the debts and obligations that a business must pay within 1 year or within its normal operating cycle, whichever is longer. To calculate current liabilities, you first need to identify all the short-term obligations listed on the balance sheet. Start by looking for accounts payable. This is the amount a company owes to suppliers for goods or services it has already received. Next, check for notes payable. These are written promises to pay specific amounts by certain dates, which may include short-term loans. Another important category is accrued expenses. These are expenses that have been incurred but not yet paid, like wages, interest, taxes, and utilities. Unearned revenue is also a current liability. This is money received in advance from customers for goods or services that have not yet been delivered. Don't forget about the current portion of long-term debt. This is the part of long-term loans or mortgages that is due within the year. Lastly, consider other short-term debts, which can include salaries payable, income tax payable, and sales tax payable. Once you have identified all these current liabilities, the next step is to add up their amounts. The formula for calculating current liabilities is simple. Current liabilities equals accounts payable plus notes payable plus accrued expenses plus unearned revenue plus current portion of long-term debt plus other short-term liabilities. For example, if a business has $5,000 in accounts payable, $3,000 in accrued expenses, $2,000 in notes payable, $1,000 in unearned revenue, and for $1,000 as the current portion of long-term debt, you would add those amounts together. The total current liabilities would be $15,000. It's important to classify current liabilities accurately. This classification affects working capital and liquidity ratios, which are essential for financial analysis and tax planning. The current portion of long-term debt must be separated from the long-term portion to reflect the correct short-term obligation. Accrued expenses should be recorded based on the matching principle. This means expenses are recognized when incurred, not when paid, which impacts taxable income. Properly calculating current liabilities helps assess a company's ability to meet short-term obligations. This is critical for maintaining good credit and managing cash flow for tax payments and other expenses. In summary, calculating current liabilities on a balance sheet involves listing all debts and obligations due within 1 year and summing their amounts. This calculation provides a snapshot of a company's short-term financial obligations and is key for accounting accuracy and tax compliance.